So let me just finally complete with some summary points. Interest rates are on hold. If they do move, it'll be down next year, and that'll be because the Reserve Bank has to substantially lower their current growth forecast of 3 to say 2.5 or 2.25 for next year. The Fed's likely to raise rates in December, and the markets aren't ready for that. We see renewed downward pressure on the Aussie coming from the Fed raising rates and the points I made to you about the fall in commodity prices associated with the way these big mining companies are running their businesses. The lower Aussie is going to continue to support the services sector. Household debt levels are very high. They've stabilised, but they haven't come down much. I believe housing construction is going to remain high. Those restrictions on investors are biting. I still see upside on Sydney house prices, but clearly not at 25%, but certainly at 5% or maybe a bit more. The best sectors are health, education, retail, construction, very much driven off those three themes of health, the ageing of the population, the tourism, exporting services, and the construction boom. There's been this widening gap between mining and the non-mining states. That's going to continue, particularly the gap between Western Australia and, say, Sydney. World markets are going to be volatile. There's this huge debate going on about exactly how strong is China. 2 points there. The first one is that the cyclical slowdown is starting to moderate in the key construction sector, but the structural slowdown in the economy as you rebalance away from the heavy industry towards services means that China's economy will gradually slow down to about 5%. And the rebalance of China means that the best years of the resource sector are gone, and the opportunity for Australia is very much finding ways to service this boost in the consumption of services in China. Thank you very much.